Ladies and gentlemen, we welcome you all to ICICI Bank's results conference call with Mr. Sandeep Batra, Executive Director, ICICI Bank, and Mr. Anindya Banerjee, Group Chief Financial Officer, ICICI Bank. Mr. Batra will now give you an overview of the results, which will be followed by a Q&A session. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you all for joining us today. The Indian economy continues to be supported by a series of structural reforms implemented over the past years and continuing policy measures. The authorities are taking various steps to maintain macroeconomic stability and support growth in the context of global headwinds and a volatile external environment. In this backdrop, we continue to remain focused on our long-term strategy aligned with India's evolving economic landscape and growth potential, of course, and being mindful at this time. At ICICI Bank, our strategic focus continues to be on growing profits before tax, excluding treasury, through the 360-degree customer-centric approach and by serving opportunities across ecosystems and micro markets. We continue to operate with within our strategic framework to strengthen our franchise, maintaining high standards of governance, deepening coverage, and enhancing delivery capabilities are focus areas for our risk-calibrated profitable growth. Our board has today approved the financial results of ICICI Bank for the quarter and year ended March 31st, 2025. I would like to highlight some key numbers. First of all, on profit and capital, the net interest income increased by 11% year-on-year to 21,193 crore rupees in Q4 2025. The net interest margin was 4.41 in Q4 2025 compared to 4.25% in Q3 2025 and 4.4% in Q4 2024. The net interest margin was 4.32% in FY 2025 compared to 4.53 in FY 2024. Fee income grew by 16% year-on-year to 6,306 crore rupees in Q4 2025. Core operating profit grew by 13.7% year-on-year to 17,425 crore rupees in Q4 2025. Provisions, excluding provision for tax, were 891 crore rupees in Q4 2025. The bank, on a prudent basis, continues to hold provisions against security receipts guaranteed by the government, which will be reversed on actual receipt of recoveries or approval of claims, if any. Profits before tax, excluding treasury, grew by 13.2% year-on-year to 16,534 crore rupees in Q4 2025. Profit after tax grew by 18% year-on-year to 12,630 crore rupees in Q4 2025 and grew by 15.5% year-on-year to 47,227 crore rupees in FY 2025. Consolidated profit after tax grew by 15.7% year-on-year to 13,502 crore rupees in Q4 2025 and grew by 15.3% year-on-year to 51,029 crore rupees in FY 2025. The board has recommended a dividend of 11 rupees per share for FY 2025. The declaration and payment of dividend is subject to requisite approvals. At March 31st, 2025, the bank had a net worth of 2.92 lakh crore rupees. After reckoning the impact of dividend, CET1 ratio was 15.94% and total capital adequacy ratio was 16.55%. Moving on to deposit growth. The total period end deposit increased by 14% year-on-year to 16,10,348 crore rupees at March 31st, 2025. Average deposits increased by 11.4% year-on-year to 14,86,635 crore rupees during Q4 2025. Average current account deposits increased by 9.6% year-on-year. Average savings account deposit increased by 10.1% year-on-year. The bank opened 241 branches in Q4 2025, 460 branches in last 12 months, and has a network of 6,983 branches and 16,285 ATMs and cash recycling machines at March 31st, 2025. Moving to loan growth. The domestic loan portfolio grew by 13.9% year-on-year and 2.2% sequentially at March 31st, 2025. The retail loan portfolio grew by 8.9% year-on-year and 2% sequentially. Including non-fund outstanding, the retail loan portfolio was 43.8% of the total portfolio. The personal loan portfolio grew by 4.2% year-on-year and 0.6% sequentially. The credit card portfolio grew by 11.7% year-on-year and 0.9% sequentially. The business banking portfolio grew by 33.7% year-on-year and 6.2% sequentially. The rural portfolio grew by 5.1% year-on-year and declined by 1.5% sequentially. Growth in domestic corporate portfolio was 11.9% year-on-year and declined by 0.4% sequentially. 74.8% of the corporate loan portfolio was rated A- and above at March 31st. On technology, we continue to enhance our use of technology in our operations to provide simplified solutions to customers and making investments in our digital channels. We further expect to strengthen system resilience and simplify our processes. Moving to asset quality, net NPA ratio was 0.39% at March 31st, 2025, compared to 0.42% at December 31st, 2024, and 0.42% at March 31st, 2024. During Q4 2025, there were net additions to gross NPAs of 1,325 crore rupees. Gross NPA additions were 5,142 crore rupees in Q4 2025. Recoveries and upgrades of NPAs, excluding write-off and sale, were 3,817 crore rupees in Q4 2025. Gross NPA written off were 2,118 crore rupees in the Q4 2025. There was a sale of NPAs of rupees 2,786 crores in the current quarter. The sale of NPA consists of 1,605 crore rupees of security receipts and 314 crore rupees in cash. The bank continues to hold 100% provisions against these security receipts. Provision coverage ratio on non-performing loans was 76.2% at March 31st, 2025. Total fund-based outstanding of all borrowers under resolutions as per various extent regulations declined to 1,956 crore rupees or 0.1% of total advances at March 31st, 2025 from 2,107 crore rupees at December 31st, 2024. The bank holds provisions amounting to 643 crore rupees against these borrowers under resolution as of March 31st, 2025. Loans and non-fund based outstanding to performing corporate borrowers rated double B were 2,850 crore rupees at March 31st, 2025 compared to 2,193 crore rupees at December 31st, 2024. The total provisions during Q4 2025 were 891 crore rupees or about 5.1% of core operating profits and about 0.27% of average advances. The bank continues to hold contingency provisions of 13,100 crore rupees at March 31st. Going forward, we will continue to operate within a strategic framework while focusing on micro markets and ecosystems. The principles of fair to customer, fair to bank, one bank, one team, and return of capital will guide our operations. We focus on building a culture where every employee of the bank serves customers with humility and upholds values of brand ICICI. We aim to be a trusted financial service provider of choice for our customers and deliver sustainable returns to our shareholders. With this, I conclude my remarks and would be happy to take questions. Thank you.
Thank you very much, sir. We will now begin the Q&A session with Mr. Batra and Mr. Banerjee. Anyone who wishes to ask a question may press star and one on their telephone. If you wish to remove yourself from the question queue, you may press star and two. Today's announcement is on the bank's financial performance. Hence, we would like to request you to ask questions related to that. Please write to the corporate communications team separately for any other queries. Due to time constraints, I request all of you to ask 2 questions at a time. If you have additional queries, you may join the queue again if time permits. Thank you. The first question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Good evening, Mr. Bhattacharya. Just wanted to get a sense on this net interest margin number, the sudden jump, 4.41%, what is contributing to this? And the second one, you talked about an uncertain global environment. Looking at your corporate portfolio, is there anything that you're looking at doing specifically at the bank, which may protect the book against any undue volatility?
No, thank you, Vishwanath. As you're aware, the net interest margin was 4.41% in this quarter compared to about 4.25 in the previous quarter. The movement in NIM from Q3 to Q4 was primarily due to impact of day count, which we had in a way highlighted earlier, CRR reduction in Q3 and some interest on tax refunds. And of course, this was partly offset by repo rate and increase in cost of funds. So that's...
Sorry to interrupt you. Vishwanath, can you please mute your line from your side?
Sure.
Thank you. Sir, go ahead.
Sorry, I answered I answered that part. And from our overall long-term perspective, I think if you recall, NIM was around 4% prior to commencement of rate cycle in FY22. And with increase in repo rates and NIM movement to the level, we had moved it about 4.5% over the last 2 years before it has declined to about 4.3% during the current year. In the near term, I think we will follow by and large what's happening in the banking system, and these margins would be impacted by repo rate cuts, and we do expect more repo rates to happen. And as you are aware, the deposits reprice happen with a lag. So we will continue to look at various ways, maximize opportunities to increase our risk-calibrated profits on a 360 basis. To your second questions around the volatile environment, specifically in the context of the book that we have built, I think we are very confident of the quality of the book that we have built. Of course, we will continue to watch the portfolio very carefully, but we will see how it goes. There could be opportunities also during this period. But our approach has always been to maintain a risk-calibrated growth and be focused on our return of capital principle, and that continues to be the same.
Thank you. Thank you very much.
Thank you. Next question is from the line of Shipra Pedkar from Informus Media. Please go ahead.
Hello, good afternoon. Good evening, sir. Am I audible?
Yes, Shipra.
So just a couple of questions. One on your loan growth and deposit growth. Are you expecting them to grow in the same pattern, or are you expecting loan growth to be higher than deposit growth? What is your view?
So both these growths have to grow in tandem. So if you see, and of course, if you see, our growth has been. We grew our loan portfolio by 13.9% during for the year against the bank, about 11%. And while we will see competitive intensity in pricing, but we do expect these growth will be a function of overall market. And I think our loan growth and deposit growth have to largely move in tandem. And if you see over last year also, they have grown in tandem. From our perspective, whenever we see opportunities, we have not been constrained by deposit growth.
Right, sir. The other thing was on slippages. Where are you seeing the slippages coming from, and also are you seeing any stress in any particular portfolio in any segment?
If I look at the slippages for the quarter, we had a total gross additions to NPAs of about 5,100 crores, out of which retail and rural were about 4,300 crores, and corporate and business banking were 803. Along with this, there have been recoveries, upgrades. The retail and rural portfolio, there were recoveries of about 3,000 crores, and corporate and business banking, we had a recovery of about 778 crores. So the net additions has been just about 1,300 crores. So I think we continue to remain focused on both the quality of our customers, and that strategy continues to remain unchanged. we are not seeing any specific trends per se, and but we will be closely monitoring our portfolio to identify any build-up of early stress. But at this point of time, the portfolio is quite stable.
Okay, thank you so much, sir.
Thank you. Next question is from the line of Siddhi Naik from Thomson Reuters. Please go ahead.
Hi, sir. Good evening. Just wanted some clarity on the numbers front. What percentage of your total retail book comprises of unsecured as of March 31st?
Out of a total retail portfolio, our personal loan is about 16.9% and credit cards is about 8%.
Total is 13.4%.
Of the total book or of the retail book? Of the total book, it's about 13%. Yes.
13%, right? And credit cards specifically is how much?
4%.
Credit card is about 4%.
4%. Okay. So I just wanted to get a sense on what trends are you seeing, especially in the unsecured book, in terms of the bounce rates, etc. What are the trends that are emerging, and how would you want to plan to grow this, unsecured book in the coming quarters?
If you see, our rate of growth in personal loan and credit card has slowed down. Year on year, our personal loan has grown by about 4.2% and credit cards is about 11.7%. We really do not have a target, and we largely look at customer segments. As long as we are comfortable with the quality of the credit, that we are happy to lend to these segments. These principles we have been talking for a long time. I mean, we fundamentally follow the principles of return of capital and assess cash flows. We are not focused on any particular segment or a product. And we always focus on known and accessible customers, try to deepen the existing relationships, which provide us liability information and credit assessments. These considerations have been helping us over the years, and that strategy continues to remain the same. Based on current overdue trends and delinquency levels, the credit quality portfolio in this segment is quite stable. And of course, as I mentioned, even for the corporate side, even here, we will continuously monitor these portfolios to identify any early buildup of stress.
Okay, sir. I'll come back.
Thank you. Next question is from the line of Shayan Ghosh from Mint. Please go ahead.
Hi, Mr. Batra. I had a question on CASA. Do you see an impact of this recent savings deposit rate cut on your CASA ratio, which anyway has been declining in the last couple of quarters? That's one. The second question is, your corporate loans have grown faster than retail. I think that was the case last quarter also. Are these fresh loans, or would it be largely refinance? And if you could give us an outlook on how these two segments, corporate and retail, will, how do you see them in the next financial year, in FY26? Thank you.
Thank you, Shayan. First of all, on your questions around CASA, I think we have been seeing a healthy growth of deposits, with average total deposits grew by 11.4% year on year, and the CASA has grown by about 10%. The period deposit was, of course, about 14% when the banking system grew at about 10%. Our focus is essentially around overall quantum and cost of deposit mobilization. And of course, CASA and retail term deposits play an important part of it. We focus on overall relationships, we focus on money in bank, and we do not, frankly, drive any particular kind of deposits, whether CASA or term deposits. Our objective is to maximize the objective is to serve the customers and do 360-degree banking. We are comfortable, and we would certainly like to be a primary bank for the customers, and that's an area of our focus, and we will continue to remain with that. Moving to your questions around retail and wholesale loans, as we have articulated earlier, we really do not have any product mix targets. We continue to assess risks, and whatever falls within our risk framework, we are happy to lend in that basis. Based on this, we have built our portfolio. the difference between the allocation between retail, business banking, rural and wholesale is an outcome rather than a specific strategy. We focus on customers as opposed to focusing on segments. So that continues to remain.
Okay. Thank you.
Thank you. We'll take our next question from the line of Lalitendu Mishra from Hindu. Please go ahead.
Good evening, Mr. Batra. In continuation with Vishwanath's question, I would like to know what would be the overall impact of the trade war and the likely disruptions to supply chain globally. If you can please elaborate. I'll ask the second question.
It's very difficult for us to make that assessment. I'm sure the authorities are on top of it. Our job, as a bank, we will continue to support our customers in this direction. So we would want to have a resilient balance sheet. We will continue to strengthen our capital position. We do have liquidity, and I think both the government and Reserve Bank of India are seized of these, and they are taking proactive steps to make India, to mitigate the challenging environment at this point of time. I think corporate India will respond appropriately. There will be challenges, no doubt about it, but there could well be opportunities for us as a country, and we will see how it goes. So as a bank, we will continue to focus on monitoring this portfolio and developments very, very carefully. We will be focused on a risk-calibrated risk-calibrated strategy which we have articulated. It has paid us well over the years, and we will continue to remain focused there.
Okay. So have you already done the transmission of the basis point repo rate cut in 2 tranches?
That happens immediately, no?
No,
that happens. And there is, for at least the retail as well as the business banking, whatever is linked to the external benchmarks, it resets within a period of about 3 months. So that happens automatically.
Both on interest rate as well, on the borrowers as well.
On the lending side, yes. There's nothing on the deposit side. Did you say deposits?
No, I didn't know the lending side.
No. Yeah. On the lending side, it is just fairly automatic. It's the regulation around it. The transmission happens within a period of 3 to 6 months. Largely 3 months, actually.
Thank you so much, sir. Thank you.
Thank you.
Thank you. We'll take the next question from the line of V. Narayan from Financial Express. Please go ahead.
Good evening, sir. Sir, the retail loan portfolio growth has sharply come down from 19% like-to-like basis last year to just 9%. So what contributed to this slowdown? That's my first question. And also, you have proposing to sell entire stake in NIT Institute of Finance and Banking. You can give what is the consideration there?
2 separate questions. Okay, one, I think the loan growth has primarily slowed down in the unsecured segments, where the loan growth for the year on personal loan was just about 4.2% and credit cards was 11.7%. As we have been talking, our approach has been a risk-calibrated growth. And of course, during this period, we have seen strong competition, intensity and pricing of mortgages and corporate loans. And given the expectations of imminent rate cut, we were focused on appropriate spreads over our benchmark during the quarter and were focused more on sustainable profitability. So that is essentially what it is. We drive our business largely from a fairness to customers and a fairness to bank, and our objective is essentially to maximize our profit before tax. So within that framework, both based on risk and profitability, we do our pricing. So frankly, we are not really concerned about between retail, wholesale, as I mentioned earlier. We would like to grow our overall book in a risk-calibrated fashion, and that is what it is. If you see, the overall loan growth for the year has been about 13.3%, and that is also very much in line with what our deposit growth is. So we look at everything over an overall thing. The stake sale is a very small amount. I think we had a JV with NIIT, which was set up, I think, somewhere in 2006. And over the period, I think We are just wanting to rationalize and simplify our own portfolio where we want to remain focused on. And as part of that, we are doing the same.
Thank you.
Thank you. Next question is from the line of Hamsini Karthik from Money Control. Please go ahead.
Hi. Good evening, Mr. Batra. Just like to understand a couple of things. The CASA ratio has now fallen well below or around 40%. I'm sorry, I don't have the final numbers with me because the presentation is not up yet. And you guys have also reduced your rates on SA. Given that there is still a reasonable fight for deposits in the market, how much do you believe there is a scope for you to tinker with the overall deposit rates and particularly more for SA? Do you believe that 2.7 is the rock bottom that we've hit, or you will want to revisit this number at subsequent ALCOs?
We largely respond to what is happening on the policy side. If you see, there has been a sharp reduction in the repo rate over the last, two rate cuts have already happened, and with further rate cuts expected in the horizon, we were of the view it is an appropriate time to make a reduction in the savings account deposit rate. So this is something that we evaluate given the macro environment. So from our overall perspective, the CASA ratio for the current quarter was about 38.4%. Now, this has very much been stable at around this level. Last year in March, it was about, again, 38.9, so it's marginally lower. So I think, as I did mention earlier, we are looking at the overall deposit. Our overall average deposits has grown by about 11.4% and about 1.9% sequentially. We are focused on the overall quantum and cost of deposit mobilization and not necessarily individually on CASA and retail deposits. Our focus has been on money in bank concept, as I mentioned earlier, and that is where we will be. We would like to be the primary banker of our customers, offering complete 360 solutions, and probably try to have maximize our share within the customer's wallet and try to serve them as best as we can. So that is essentially where we are.
Perfect, sir. There is also a notion that money might move out of SA to liquid funds which offer better rates. I know it's a little too early. We've just been about 10-15 days since the rate adjustment. But are you seeing any initial signs of it? And is it something as a trend that you would possibly be very watchful of, given that bulk also matters, bulk deposits also matter quite significantly to large banks, including yours?
No, that is one way to look at it. I think there are all kinds of customers. Banking is largely a transacting account. And liquid funds have been around for a very long period of time and across various cycles. I think whatever money remains, money largely remains within the banking system. So our focus is to maximize whatever the customer needs. I think our focus is on our customers, trying to deliver whatever he or she wants, and we will remain focused on that. And we do hope once we are able to deliver 360 and being a complete banking suite, we will have the deposits that we need. So as I said, we are not really focused on. If a customer wants to have liquid funds, invest in liquid funds, we are happy to support that as well.
Perfect, sir. On the loan side, there has been a deceleration in growth on a sequential basis on rural banking, and it's also seen the weakest YOY growth, 5.1% or so. Earlier today, another bank also indicated that some sort of stress building up there. What really led to you slowing down? And if you could give a little more color in terms of the quality of pressure that you're facing there in rural banking, both in terms of asset quality as well as challenges on the growth front.
No, I think our growth is largely a function of risk-calibrated approach that we take. I don't think so. In our assessment, there is any specific stress which I need to call out. We have had a growth of about 5.1% during the course of the year at rural. That's on the rural loans, and they contribute about 6% of our overall book. We are happy with the quality of the book that we have built over here, and we will continue to expand it in a risk-calibrated fashion. So there's nothing specific that I could want to call out here.
Okay, sir. Just one small request before I leave. A request, if you could please put in your presentation so that our questions can be a lot more informed. I mean, this is whatever we're doing is based on the basic press release, so it's not helping our case much.
Yeah, we will just do that shortly. So thank you. Thank you for that. Thanks.
Thank you very much. Our next question comes from the line of Ashish Agassi from PTI. Please go ahead.
Thank you so much, sir. I hope I'm audible. What percentage of your book would be linked to external benchmarks, and how much would be to others?
Our external benchmark, our fixed loan book is about 31%. 53% is linked to repo, and about 15% is linked to MCLR.
53 to repo, right, sir?
53 is to repo, 15% to MCLR, and 31% is fixed. Broadly, that is how the split is.
Okay, sir. So, sir, given 53 is repo, what sort of outlook do you keep on the margin front going ahead? You just mentioned that, okay, it would be in sync with the industry, but do you expect sort of a sharper movement down, or what sort of outlook do you keep there, sir?
No, I think from an outlook and a business strategy perspective, we are focused on PPT, and NIM is, of course, an important lever as part of that. There are product mixes, and there are levers as a repo rate cut happens. There is also a corresponding actions that we can take on the deposit side. As you are aware, we have reduced our savings bank account yields. And over a period of time, depending on competition, etc., we will continue to look at even the fixed deposit rates. As you are aware, the repricing of the loan book happens much faster than deposits. To that extent, there will be some kind of a mismatch. So beyond that, as a bank, we are clearly focused on, as I mentioned, to the profit before tax, and not. Of course, NIM is an important component of that.
Okay, sir. And sir, has there been any review undertaken at the bank's side, say on derivative trades and other things, especially after some surfacing of some difficulties at a peer bank?
No, we continuously do that review. I mean, between from internal audit, etc. Based on our reviews, we are very comfortable with the accounting treatment and the book that we have built over here. So there is nothing to worry about on this count at all.
Thank you so much, sir.
Thank you. We'll take the next question from Ram Kumar from Hindu Business Line. Please go ahead.
Hello.
Yeah, Ram Kumar.
Good evening, sir. Yeah. Good evening. So your board today took a decision on buying back securities. So I just wanted to understand, how much of these securities will you be buying, and what will be the effect of this buyback of these securities actually? What is the purpose of this purchase?
So this is just enabling approval that we take annually to do any buyback of debt securities if there are opportunities in the market, if markets are dislocated. But it's more of an enabling approval, and there's no specific plan.
Okay. It is not with a view to, refinancing, because older securities you would have contracted at a higher rate. So, anyway, rates are coming down in the market. So maybe you are replacing the older securities with the newer securities actually. Is that the way you are looking at?
So typically it wouldn't work that way, because the holder of the higher yielding securities would not want to give them up. So these are, only if there are market dislocations of some kind, sometimes there are opportunities, but typically we are not, it's more of an enabling approval. There's no specific plan.
Yeah. And also you pointed out about this, capital strengthening actually. Okay. So what is the kind of capital and strengthening exercise you are undertaking? Any plans to raise money through probably equity, through AT1 bonds, What exactly is your plan?
No, we don't. Even the Tier 1 and 81 approvals that we have got, these are more enabling in nature. So there is no specific plans to be done, and whenever we see an opportunity or a need, both from a pricing point of view, we will do that. So,
yeah. And can you give us an outlook on deposit and credit growth? This time it has grown by 14%. Do you expect it to be higher than this or lower than this? What exactly is the solution? Yeah.
Ram, it's very difficult to point this out. A lot of it depends on macros, how RBI looks at it. It is an environment you are all familiar with. So we will try to continue to remain nimble and react to both opportunities and risks in an appropriate fashion.
Yeah, and one last question about branch addition. This year, how many branches will you be adding?
So during the last year, we added about 624 400, a little over 400 branches. We do expect to add a similar number of branches during the next year.
Thank you.
Thank you very much. Next question is from the line of Advait from Bloomberg. Please go ahead.
Hi, good evening, sir. Just wanted to know, given that sequentially the retail loan growth has come down, is it just less demand for loans, or is it probably from your credit assessment? Even though inflation is down and the economy has rebounded, do you expect consumption to be weak or from a retail loan standpoint? And on the corporate loan side, given that tariffs is a bit of a mixed basket as to the impact on specific sectors, has the bank taken any sectoral calls in terms of trade finance, supply chain finance, export-oriented companies?
No, I think there are 2-3 parts of it. Our approach has been having a risk-calibrated growth. You have seen the numbers for both corporate and retail. On the business banking side, we continue to see a healthy growth. We do have an integrated approach covering coverage, credit, delivery to our customers. Our corporate portfolio is about 20% of our overall portfolio, and it is doing well. The business banking portfolio is also doing very well. We look at customer from a 360 degree and assess the total relationship value with the customers and ecosystems. So I think, as I did mention, given all the impact on tariffs, this environment externally will remain volatile, we will continue to remain nimble. We will continue to remain focused, and for the segments that we are comfortable and which meets our risk threshold, we are happy to grow the segment also. We do believe while there will be risks, there will also be opportunities during the course of the year, and we will be mindful of both.
On the retail side, I think sequentially it's sub 1% is what does that reflect that people aren't borrowing as much as they should? Whether they could, or should we just see that as your credits that are coming to you, to the bank?
No, I don't think so. Because we look at a customer, and in case there is a need, and we are more than happy to lend. I don't think so there is any specific segment which I can really call out whether customers are borrowing, not borrowing. Every customer who is bankable, we are happy to lend to that segment.
Thank you.
Thank you. We'll take the next question from the line of Anupreksha Jain from Business Standard. Please go ahead.
Hello, am I audible?
Anupreksha?
Yes, ma'am.
Yeah. So my first question is regarding, so how do you see tariffs impacting the international business given that the volatility has increased in global markets? And second, I want to know about how is the attrition rate so far, and where are we seeing on retaining people or employees? And thirdly, growth guidance on NIM. Just want to know these 3 queries.
Oh, that's lots of questions, Preksha. Let me try to answer them. Coming on the tariffs, I have in a way sort of answered it. There is a uncertain global environment, and of course, it will put pressure on long-term growth, and we will continue to prioritize resilience, and we will continue to look at the customer segments which we believe are strong and which meet our risk threshold. So that is a strategy. We will, as I mentioned, we will continue to remain nimble and focused. The second question was on your on the attrition rate. These rates we will give it as and headcount we will probably give it as part of our annual report. And the third question was around what was the third question?
Growth guidance on NIM.
No, NIM, as I did mention, I mean, there are many moving parts such as extent and timing of further repo cuts, quantum and timing of decline of both retail and wholesale deposits, competition intensity, global uncertainty and liquidity. While the quantum of rate cuts expected has increased, we have also seen moderation in retail and wholesale deposits. So the NIM trajectory over a longer term, it's difficult to call out, but in the past, NIM was around 4% prior to the current rate hike cycle, which started at the end of FY22. When the rate increase happened, our NIMs moved from about 4% to about 4.5% in FY23 and 24, before declining to about 4.3% during the current year. So in the near term, by and large, we will be in line with the banking system. We will, of course, our margins will get impacted by repo rate cuts because a fair bit of loans are linked to the external benchmarks, which reprice pretty fast within a 3 to 6 months period, and deposits reprice with a lag. So from our perspective, we will continue to look at ways to leverage the overall franchise to maximize risk-calibrated profits and look at all the levers, of which NIM is one of them.
Thank you.
Thank you. We'll take the next question from Falakna Said from Deccan Chronicle. Please go ahead.
Slippages are more from the retail book. Are there any segments that you will focus on, and which are the segments you will want to stay away from? And the other question is on MCLR rates. It's almost 3 months, 2 rate cuts have happened. This EVLR rates have fallen, but we are not seeing anything on the MCLR rates. When do you see MCLR rates falling for the banking sector and also for your own bank?
So, Falak, I think we will be watchful of the situation. I don't have any specific guidance on deposits, as I think we have already explained that this is all external linked. On MCLR, it's formula based. I don't think so we have too much of flexibility. There is a whole formula prescribed by Reserve Bank of India, and based on that, whenever it is more linked to the deposit repricing, and as I did mention, deposits reprice with a lag. As the deposit rates reprice, the MCLR also will go down. So that is on the deposit side. There was your first question was on?
The slippages are mostly from the retail loans.
Falak, I don't think so. We are focused on any segment as I've been talking about. We are focusing more on a customer. And if a customer is good, the segment that you see is more an outcome of the quality of customers that we have onboarded. There is no specific area or sub-segment within a retail that we need to call out. And I think if you see the overall numbers, they are well within our thresholds, and we are quite comfortable with the quality of book that we have built.
I see. Can you give a breakup of the retail slippages?
I did mention it, but probably I will read out for your benefit.
In Q4,
sorry?
4,300 crore is retail.
That's right. That is right.
Yes. So can you give of that how much more? Mostly it has come from which segment?
Falak, we don't give further splits. This is retail and rural combined. So out of this 4,300, 3,000 was also there were recoveries and upgrades happened. So.
Okay. Thank you.
Thank you. The next question is from line of Ben from New Indian Express. Please go ahead.
Good evening, Mr. Batra. Hello. Can you hear me?
Yeah, Ben. Yes, Ben, go ahead.
Yeah, Mr. Batra, this is further to the trade war issues.
I don't know whether you give a breakup. What is your total corporate book? How much is your trade finance? Can you give that number? Just to know the impact, whether it goes for a toss, what would be if the trade war gets worse than what it is today?
No, we do not give that Ben split. I mean, it's very difficult to give that kind of a split. I think corporate India is strong, and they are taking effective steps to steer the challenges that have emerged at this point of time, and we will see how it goes.
Okay. And my last question is on there are reports about the credit card delinquencies rising and the personal loan delinquencies rising. How is your book? These two books? Is the total slippages? Can you put a percentage to that? Whether it came more from these two books?
No, we have no. Of course, I mean the credit card is a product which has a relatively higher provisions, which is the nature of the product. Mm-hmm. But we have built our overall retail portfolio on the fundamental premises of capital and cash flow assessment. So we try to work with borrowers who are known and accessible. We continue to remain focused. The delinquencies on unsecured portfolio has been marginally higher over the last 1 year, but they are low in the overall context. So as you are aware, over the last 12 to 15 months, we have strengthened our credit parameters, which is a combination of profile, track records, bureau score, leverage, etc. And we have sort of strengthened these areas. The overall loan growth, based on that, the personal loan growth has declined by about 32.5%, which was there in Q4 of 2024, to about 4.2% in the current quarter. So we have taken effective steps to reduce the growth rate, which is in line with our assessment of the opportunities and risks that we see in the portfolio. But overall, we see the unsecured portfolio stabilizing, and as it does, we'll be happy to grow that portfolio.
Okay. And how big is your PL book and the CC in terms of assets, overall assets outstanding?
So the overall, credit, sorry, you're talking of credit cards or CC?
Credit card and as well as a personal loan, unsecured personal loan. The book size.
So the book, the credit card has a book of, no, you asked the absolute amount. Credit card is about 57,000 crores. That personal loan is 1,21,000 crores.
1,21,000 crores. Okay, thank you so much.
Thank you.
Thank you so much.
Thank you. Thank you, Ben.
Thank you very much.
Thank you. Thank you so much, and hope have a good evening, and thank you for being with us today afternoon.
Thank you very much. This brings the conference call to an end. On behalf of ICICI Bank,